What's up, guys? So right now, there's about $162 billion of apartment loans coming due this year. And by the way, that's just apartments. If you look at the broader commercial real estate space, it's close to $1 trillion of loan maturities that are coming in 2026. And a lot of people hear numbers like that and naturally assume that the whole market is about to crash. We're about to have a 2008 style meltdown. The world is going to end. It's going to take 10 years to recover. And I don't think that that's true, because here's the part that a lot of people are missing. There are two apartment buildings that can sit on the same street with the same tenants and the same rents in the same neighborhood, and one owner will be perfectly fine, whereas the other might be about to lose their property. So the reason is not because the building is bad or real estate's broken or anything like that, but it's because the debt is bad for one of those owners. And if you invest in real estate passively through fund or syndication, or if you operate anything yourself, this is probably the most important thing that you can understand right now, because this one distinction is going to separate who makes money in the next 18 to 24 months and who gets hurt in this market. So let's break it down. Let me make this as straightforward as I can. Between 2020 and 2022, a huge wave of apartment deals got financed with short-term floating rate loans. And at the time, borrowing costs were around 3%. Well, these loans are coming due now, or they've been coming due. And refinancing today costs somewhere between 5.5% and 7%. So nothing about the buildings that were financed changed. The tenants didn't leave. The rent checks are still coming in. But the debt payment has just jumped by 50 to 80%. And if the property's income can't cover that new payment, the owner has a problem. Now, let me put a number on it so this is concrete. Let's say an operator bought a 100-unit building for $15 million. They put in $5 million of investor equity, which they raised from passive investors, and they contributed a little themselves, and they took $10 million from a bank at 3.5% interest. That's about $350K of interest a year, assuming it's interest only. Now that loan comes due because a lot of these loans are 3, 4, 5-year durations. And let's say the new rate is 7%. That same $10 million loan now costs $700,000 a year to service. That's double than what it was before. So if the building produces $900,000 in net income, going from $350K in debt cost to $700K in debt cost, means your cash flow just cut more than half. And that's before anything went wrong with the property itself. But the interest rate is only half of the problem. Property values have dropped since their peaks in 2022. That $15 million building might appraise at only $12.5 million today. And the new lender isn't going to lend $10 million against a $12.5 million building. Maybe they'll only lend $8 million, but the old loan is still 10, and that's coming due. So there's a $2 million gap that needs to be filled in order to refinance the building and keep the deal going. That's cash that the operator needs to bring to the table just to refinance the deal. And it's not to improve the building. It's not to increase the return. It's just to keep the deal alive. So where does that cash come from? Well, either the operator is flush with cash and has reserves, which many to most of them don't, or they come back to investors or ask for more money. That's called a capital call. And this is happening all across the real estate market, not just on one deal, not isolated deals within portfolios. There's some operators that have this happening to 60, 80+% of their properties. So thousands of properties are facing the same math at the same exact time. That's called the debt wall. And it's not necessarily a real estate problem per se. It's a math problem that's layered on top of a valuation problem, and it's all kind of colliding at once. So what actually happens when an operator can't refinance on good terms? There really are only 4 options. And if you're a passive investor in any of these deals, or you're looking at real estate today, you really need to understand this. So option 1 is the operator refinances at a higher rate and the building's valuation will actually support being able to do so. This is probably the best case scenario in today's market. And it's not happening very often, by the way. But the deal survives, cash flow maybe drops significantly because now there's incurred debt costs that are much higher than what were underwritten. And as a result, investor distributions maybe get cut or they get paused entirely. The building is fine. Maybe the returns aren't going to be what they promised, but we live to fight another day and let some of this distress work its way through the real estate cycle. Now, option 2, which is happening very widely right now, is the operator does a capital call. That means that they come back to you, the passive investor, and they ask for more money. Either it's to buy down the rate, maybe it's to cover the equity gap we just talked about, but either way, you're writing a check on a deal that probably hasn't performed the way it was supposed to. And if not enough investors participate, this could be table stakes for the deal staying alive. Now, option 3 is they sell the property. Now, sometimes that's at a loss. And if the building was bought at peak pricing with aggressive debt, selling now might mean investors don't get all or any of their capital back. You get 80 cents on the dollar, maybe 20, maybe less. And particularly in some of the markets that have seen a massive wave of supply come online, like in the Sun Belt, this is not an opportune time to be selling, even if the demand trends are there. So this is often a pretty suboptimal option. And last, extend and pretend, baby. The lender extends the loan. Now, this has been happening a lot, particularly in 24 and 25, but we're at an era where lenders are losing patience and they're not doing this nearly as much as they were before. But the strategy is basically kicking the loan out, allowing for renegotiations, and lenders have extended what they can, about $400 billion of previously extended loans, but they're now hitting the maturities on the extensions, right, in 25, 26, 27. So it looks like a lot of lenders are not coming back and saying, let's keep playing that game. And the reason that this all matters to you as a passive investor is you don't really control which option gets chosen. The operator does, right? So the quality of that operator is what determines whether you come out okay, whether you take a partial loss or a total loss. This really is an important factor into the health of your deal, especially for those that did deals in the early 2020s. Now, this is where things get really interesting if you're thinking about where to go from here, because I'm a very opportunistic thinker. I like to see what's going on around and go, where's the edge today? Where do we go counter trend or find distress and opportunity to make money going forward? Because as this works its way through the system, it's going to set up an incredible buying opportunity if you know what to look for. Now, not all distress is the same, and understanding of the difference is probably the single most important thing I can share with you all day. The first kind is what I like to call financial distress. This is when the building itself is healthy, tenants are paying, occupancy is strong, the neighborhood works, but the capital structure is broken. That's the debt we've talked about. The owner used too much leverage, or the bridge loan is resetting at a rate that doesn't work anymore. The asset is fine, but the debt is the problem. And this kind of distress can create real opportunity because somebody with better capitalization can step in, restructure the financing, and own a performing property at a meaningful discount. This is where a lot of money can be made in the current cycle. Now, the other kind of distress is operator distress, and this is the one that passive investors really need to watch for. Now, this is when an operator bought an apartment complex at maybe a 3% cap rate or a 4% cap rate, took out floating bridge debt, underwrote 5% annual growth, and assumed they'd refinance in a better position in a few years. Good luck with that. Most of that, if not any of that, did not play out, right? And rents have not gone the way those 5% protections had said. That bridge loan is resetting, or their floating rate agency debt is resetting. And now the operator is coming back to investors and asking for more capital or more time. And that's not just a debt problem, that's a judgment problem. That's a timing issue. And the original assumptions are wrong. So pouring more money into a deal built on bad assumptions oftentimes doesn't fix it, right? Don't throw good money after bad. So when someone tells you that there's going to be distress in multifamily, the first question you should ask as an investor is, what kind of distress? Is it a good building with a bad debt? Or is it an operator who got the fundamentals wrong, or there's issues with the building? There's something else that could really undermine the strategy of what you're buying. Because one of those opportunities can be fantastic and the other can be a trap. Is it a good building with bad Or is it an operator who got the fundamentals wrong, or there's issues with the building? There's something else that could really undermine the strategy of what you're buying. Because one of those opportunities can be fantastic and the other can be a trap. So where does this actually create opportunity for someone to be allocating capital right now? I think there are two setups that are emerging if you're trying to do anything in real estate equity investing. The first is in high supply, high demand markets. I'm talking about parts of the Sun Belt where a lot of new apartments were built during the boom because there were demand trends of people leaving coastal and northeastern cities for places like Austin and Phoenix and Atlanta and Charlotte. You know the story, right? But the vacancy is now up because of the supply and the development that happened here, and rents have softened. So operators with floating rate debt in these markets are feeling a lot of pressure right now. But these markets are still in a long-term demand swing that likely isn't going to change. They have population growth, they have job growth, companies are moving in, affordability relative to the coasts. And if you can find a well-located asset in one of these markets where the only problem is the debt and not the building, that can be a very interesting setup for patient capital. Now, don't assume it's going to be an easy deal. There definitely needs to be very conservative underwriting given current vacancy, given kind of lower, slower growth in the near term as that supply wave burns off. But longer term, these are really interesting assets. And we're kind of scratching along the bottom right now in terms of pricing in some markets down 30 or 35% from peaks. That's a pretty interesting setup if you ask me. Now, the second opportunity is supply-constrained markets. These are places that didn't get overbuilt. Think parts of the Midwest, parts of the Southeast that were a bit more disciplined. Vacancy here stayed tight and rents are still growing because there isn't a giant supply wave that's been absorbed, even if the demand was just stagnant or there was just sort of a persistent but not growing demand. So there's less obvious distress in these markets, but occasionally you can find a deal where the capital structure is broken even though the property performs well. And those can be some of the best opportunities in today's market because the fundamentals were never the problem. And here's the macro tailwind behind all of this. While this debt pressure is playing out, new construction has dropped sharply. Developers started more than 700,000 apartment units in 2022, and that number has fallen incredibly dramatically. So the supply wave that we're dealing with today has already peaked, and we're about to enter a market that's actually going to start being more and more supply constrained, which means that a few years from now, this market could totally flip. Less supply, rents moving up, and the people that bought well during this window today will be in a very strong position to capitalize on future rent growth, which increases the valuation of your building exponentially. So let's wrap it all up. If you're evaluating a real estate investment right now, or you're considering something in the space in 2026, whether it's a syndication, a fund, an allocation with a firm like ours, Ocean Ridge Capital, here's the framework that I'd like to use. Super simple, back of the envelope. But first, ask about the debt. When does a loan mature? Is it fixed or floating? What does the refinance look like at today's rates? And if the operator can't answer those questions cleanly or it doesn't underwrite, that should be a major red flag right off the get-go. Now, second, stress test the rents. Does this deal work at today's actual rents? Does it need 3, 4, 5% annual rent growth to hit the projections? Good luck with that. Now, it could happen in the out years, and I'm actually very bullish for the end of the 2020s for rent growth, but I don't want to underwrite that today. I want to be incredibly conservative here. And if the deal only works with optimistic assumptions, then you're taking way more risk than you probably realize. Now, third and final, evaluate the operator, not just the deal, right? This is all about the jockey, not just the horse. Have they been through a cycle before? The down part of a cycle? Have they really been through hard times? How did their existing deals perform when rates went up? And are they doing capital calls on other properties? This track record may be worth more than any projections today. So in sum, real estate is one of the best vehicles for building durable, tax-efficient, passive income and compounding wealth. That has not changed. But right now, the market is separating the disciplined from the hopeful. And as a passive investor, the single best thing you can do is make sure you're on the right side of that line. Now, if you want to figure out what kind of real estate allocation actually makes sense for your situation, we built a short quiz that walks you through it. It takes about 2 minutes. I will put the link to that in the comment description below.